I'm often asked, what's the essence of trading success? After all, if you've written 18 odd books published by the Financial Times and Macmillan and been translated into so many languages, people say, well, you must know a little bit about the essence of trading success. Can you put it all, compress it all into a brief summary? Well, actually, if there was one image which I would show you which summarizes the essence of all trading success, it would be this one. What are we looking at then on screen? What are you showing us, Alpesh? What I'm showing you is this. It comes down to A, B, C, D. Whenever you're trading, A is the point of entry. It's where you get in here. It's marked by a little green arrow, which our signal system tells us within the fund, within our hedge fund, when we should be looking to buy. Obviously, that's the obvious one. When should we buy? In other videos, I'll talk about how we get in. But I want to point out something obvious. Notice that it wasn't down here. It wasn't at the bottom of the start of the trend. We're not trying to pick bottoms and we're not trying to pick tops as professionals. If you don't take my word for it, have a look at the autobiographies of any hedge fund managers, let alone my own, Mind of a Trader, but have a look at the autobiographies of any hedge fund manager, any interviews with them. They're never trying to pick the tops and bottoms. They want to wait for somebody else to do that. And then they get in because that's when the odds have already increased and improved in their favor. Okay, so point A is our entry point. All right, how do we decide where that is? As I said in other videos, I'll discuss how we know when to get into a market. Point B is the stop loss. How do we know where to put a stop loss? Well, first of all, we've always got to have a stop loss. If we don't always have a stop loss, then what will happen is we'll get an indeterminate loss. We'll get a big loss and we'll lose out. Now, the trick is, where do we put a stop loss? Again, I'll go into more detail in another webinar and other videos, but just to give you an outline, where we put the stop loss is at such a distance, either because of experience or because of mathematics, that it won't just get hit by market noise. We know market noise is how much the market moves up and down in any given period. We want to put the stop loss far enough away from all of that so that we know that if the price were to go down there, then the chances of our original viewpoint coming true, which is this move, are relatively limited. Where you put that stop loss will often, when you're experienced, come down to experience. Until then, you might look at mathematics. You might just look at by your eye. You might say it's the recent low, or you might say, well, let's see how much this is moving on average up and down over the past, say, 14 periods. Let's make sure this is 2 to 3 times further away from that when we get our entry. Okay, so stop loss is critical, and that's what we call a volatility-based stop loss. The more volatile the market, the further away the stop loss. But so that you don't lose more money just because the market's more volatile and therefore the stop loss further away, you also have something called volatility-based position sizing, which means that the further away the stop loss, the smaller your position size, so you still only risk losing the same amount of money as if the market was less volatile and therefore you're stopped closer. That way, you're not taking more risk in more volatile markets, but it also allows you to have bespoke for any market conditions that stop loss, because it's always based on the volatility of that particular market at that particular time. A and B. What about C? C on this market, on this image up here, you will notice is a red dotted line. That is not your profit target. That is a huge mistake private investors make. They say, oh, I must have a reward greater than my risk ratio. What they're doing, if they make that into a profit target, is capping their profits. Instead, it's the exact opposite of a profit target. We're not looking to sell out and close our position. We're looking to add to our position. Why? Well, because if we're already in profit when the price comes up here, then what we're doing by adding a new position is risking our profits, not our capital. Well, I would like to happily reinvest my profits, thereby make even more profits as we have done in this market, because the price moves up and up and up, as opposed to just taking our profits, capping them, and losing out on a big move. So you might ask, well, where are you going to put point C? The eagle-eyed ones amongst you will have noticed that point C is equidistant to point A as much as point B is. In other words, it's a mirror reflection. Okay, and point C, when we add to that profit, make no mistake, my friends, when we add to that profit, we will have a stop loss, which will be at point A. It'll be a mirror reflection. We will, okay, have a stop loss, which is at point A when we enter at point C. I mean, what we do in our fund is we make sure we've got all of this set up for us so we know exactly where we stand to buy and how much risk we are taking. We can get the computers to do that for us on software like this. But my point to you as private investors, and showing you this, which is for private investors, intended for private investors, is to show those principles. But there's one other letter missing. There's point D. Yes, the losing trade. Look, we got a red arrow telling us to sell, but the market moved up and away. Alpesh, you're showing us losing trades? Surely you hedge fund managers are supposed to be so brilliant you never have any losing trades. Actually, we do. But any good strategy is such that all losses are, and write this down, small in size, short in duration. That's the essence of a good trading strategy, and that's what you see there with point D, small in size, short in duration. If I were to sum it all up, the word Selma, sum it all up. There's a stop loss. We need to know where to put an entry. We don't use limit or take profit orders. Okay. Our mind, I should have written mind there. Mind is calm. We know how much money to put into a trade such that if our stop loss is hit, we don't lose any sleep over it. And we add to our winning positions, which is probably the most important thing. Now you might say, well, wait a minute, does this mean I've got to sit in front of the screen all day long? No, it doesn't. Because when you've got this point A, okay, then you know where the stop loss is because that's going to be volatility based. Therefore, you know where you're going to enter if the price moves up, and you can leave an order with the broker to say, if the price hits this level, please buy, and please then include a stop loss with that order over here. And that's it. And you're gone, and that's job done. You can, if you're not going to be at the screen, make that a trailing stop loss. If you are going to be at the screen, you can wait and look at the market. And when the initial conditions for entry, which we'll talk about in other videos, are no longer met, you can exit. Okay, so something there for absolutely everyone. And the principles of trading from a hedge fund taken to private investors. And that screen was intended for private investors. That's the essence of all trading success.